local people, important issues. CBS 10 WILM's weekly focus on the Lower Cape Fear region. This is Byline Wilmington with your host, Don Ansell.
Welcome and good morning. Well, most of you watching today have some connection with the stock market, whether it's a 401k or another stock investment. In mid-September, the market saw some of the steepest declines since the Great Depression. Today, we're looking at what happened with some perspectives on where we go after the fall. Our guests are both experts in their fields. Vinton Fountain is one of the leading financial experts in the region and the president of Vinton Financial Associates. And Dr. Clay Moffitt, good morning, is a assistant professor of finance at UNC Wilmington. And thank you for both joining us this morning.
Glad to be here.
Before we get your take on what happened over the past year, I want to get your sense of how the market, or how you think the market might react to this economic recovery package that is being proposed, and probably in some form will be passed, and some are saying it could hit like $1 trillion. Clay, what kind of impact do you think it might have on the market?
Hope springs eternal. You know, the market generally consists of optimists, people who think stock's going up, otherwise they generally wouldn't be buying. You know, whether or not their beliefs, turn into reality remains to be seen. But
so you think it might be a boost to the market to think that there's some kind of action being taken?
I think people are excited to see action being taken, and obviously in those favored industries such as GM, the impetus or hope of a bailout has helped that stock. But what the long-term repercussions of it are, I'm honestly not so optimistic.
Vinton, what do you think?
Well, I think it'd be hard for it not to have some positive impact. None of us know when that's going to happen, of course, but when you look at sort of where interest rates are with monetary policy and what's coming supposedly with fiscal policy, tax reductions and spending, it's going to have some impact. Whether it's enough is yet to be seen. But I think that's probably one of the few things that we can be optimistic about, and there are some things, and that's one of them.
That the government's acting.
The stimulus, yes.
Yeah. The stock market lost close to like $7 trillion in 2008, and the Dow alone closed down, I think, 34%. Now, Vinton, let's say I'm a client of yours, and I don't know too much about how the stock market operates, so tell me what happened.
Well, it's sort of like Yogi Berra said, it's deja vu all over again. I think irrational exuberance hits again, except this time it's in real estate. And because the bubble built and the Wall Street and Main Street all contributed to it, I think our economy got ahead of itself, and as a result of that, just like all previous bubbles, we have to unwind. So in a lot of ways, while it feels completely different, and inside of this cycle it is different, but it's still an economic cycle where bubbles are built and then bubbles are burst.
Clay, you have anything to add to that?
You hear a lot of talk about trying to lay blame. The market's gotten greedy, or all of these things.
Well, that's not news, though.
That's not news.
Right.
Been that way ever since the beginning. That's why people are, bottom line is that's why they're in the market. They want to make money. To me, the problem and the fault goes back actually to 1995, when the government sought to regulate political policy as a market demand. Congress, in rewriting the Community Reinvestment Act, basically required banks and lenders to lend to people who were not qualified to pay the loans back.
Well, so what part did lack of regulation and oversight play?
I'm probably in the minority on this, but I would say the market is terribly overregulated. First of all, it was the regulation, the amendment to the changes to the CRA.
Doesn't think that, I don't think. But anyway, no. we'll get down into the particulars of that.
Yeah.
I'm sorry, go ahead.
No, that's okay. Yeah. If you go into the office of the SEC, you can see some of the books behind me. They have regulations that would fill shelves in volume. And it's gotten to the point where in the market, we no longer know or can really define what is lying, cheating, and stealing. You look at Howell Raines, who was the head of Fannie Mae for a number of years. He basically cooked the books, got himself a $240 million bonus. Okay? The SEC convicted him of fraud. He had to pay a $50 million penalty.
Should Wall Street be more tightly regulated?
Well, I think
Vinton?
so. I think
You do.
I think parts should be. I think the most recent story with Bernard Madoff is an example. I think that some things fell through the cracks, and I think there are going to be some changes at the SEC as a result of that. Unfortunately, it's a case of where a few bad apples sort of spoil the whole harvest, and I think on Wall Street and in the investment community that's true. There are some folks that do things that are inappropriate. Unfortunately, there are a whole lot more people who do things the correct way. But I do think as a result we'll see more regulation.
I'm curious about how you reacted when you realized that the market was in big trouble. How did the process unfold for you, Vinton? Because I know you're watching it very closely every day. You represent clients that are in the market.
Yes. Well, after I took my head off my desk and turned the TV off.
Well, I mean, was there a moment, or was it a process of oh, whoa?
Yes and no. On a kind of bigger picture level, it was time for the market to pull back. So in a lot of ways...
Did you know that ahead, or
yes.
is that in hindsight only?
No, we knew that ahead. I mean, when you looked at what was going on with real estate, it was pretty obvious that things had gotten out of hand.
Was that at the peak or when it started to decline?
That was actually at the peak.
So
When people would come in and say, I want to cash out my 401k because I want to speculate on duplexes and turn those duplexes for a quick profit that's really easy, that should just be indefinite forever.
So you saw it coming?
Oh, yes. Yes.
Clay?
My crystal ball is no better than anybody else's, but when you look at certain, underlying things in the market, and you saw the housing bubble start to burst, which coincidentally, the housing bubble began with the passage of that Community Reinvestment Act back in 96, 97. You could see historically housing and inflation trend together, but about that point, housing started widely diverging in price appreciation. So once the housing market started to slow down and burst in 2006, early 2007, it didn't take a great deal of insight to know that was going to have wide-ranging repercussions.
Okay, we're going to come back after our break, and I want to talk to both of these folks about their reaction to some of the most respected companies announcing they're on the verge of collapse. Bear Stearns, Goldman Sachs, Lehman Brothers. We'll be right back. Stay with us.